Hello everyone, I'm Steve Savant, syndicated financial columnist and money color commentator. On today's show, building your own portfolio, part one in our series on understanding asset allocation. Well, welcome to our first segment. We're going to be talking about building your portfolio. This is kind of a daunting task, and in many times you should start thinking about talking to a financial advisor who actually has experience and has done this not only for his own practice, but for many other people. Get a little bit of 5 year, maybe 7 years under his belt, under her belt, so that you can really feel comfortable with people helping you build this. There are do-it-yourselfers, no doubt about it, but I suggest you always use a financial advisor, a professional who's been in the market 5 to 7 years minimum, who has done this before, and especially if they've went through the 2008 debacle and they were able to treat their clients somewhat right, keep them apprised. This is a difficult thing about understanding asset allocation. There's different assets, and we use asset allocation to do a phrase that I like called divide and conquer. You don't want to put all your eggs in one basket. You want to be able to put them in different asset classes, and we want to make sure that not always do we want them to correlate with each other. Maybe bonds, when they're going up and the stock market's coming down, I have a combination so I can kind of like maybe try to live within the best of both worlds. So I'm trying to always make asset classes, but before I do any kind of cherry picking through all the asset classes and understanding what that means and building a portfolio, I need to do a risk tolerance test. Now, a risk tolerance test isn't really perfectly science, but it's a great starting point, a good first step in determining your financial profile. A risk tolerance test may have 25, 30 questions. If you say, Steve, I've never taken a test like this, there's a lot on the internet and online that you can take. I have one. If you write me at steve@lifesizesolutions.com, I'll be happy to send it to you. Take the test. Remember, you have to do it honestly. If you have a spouse, do not take the test together. Take it separately so that you can get a good empirical result and that you can start making some beginning judgments on what you are. You know, it's going to come out and say to you 5 different classifications. Are you conservative, conservative moderate, moderate, moderate aggressive, or aggressive? Basic adjectives that'll kind of get you into an idea of what you need to look for, and then you can go out to Morningstar. Morningstar will help you understand some basic terms like alpha and beta. Beta is a big one because it's a risk issue, and we want to make sure that if I have a conservative mindset, if my psychonomics, if my test results show that, I want to start looking at low beta. I don't like to risk principal, and if I'm going to be in the market, I want to know how low can I go and still make a little bit of a return. So when I'm building asset allocation, when you asset allocate, you're dividing and conquering. Now, you'll notice that there's allocation models. Now, I like this first one, an equity. Well, in equities, a lot of people like equities because they grow. They grow faster. If you took the rule of 72 as an example, and you had a 10% return, your money would double in 7.2 years. You're just taking the interest rate, dividing it into the time of the year, and that would give you I'm giving you the easy one, 7.2 years your money would double if you were getting 10%. So that rule of thumb. So I like the use of a fast car here on equity. I also like the idea of using cash. They're using not only a truck, but they're using a truck that has an air conditioner. It's a reefer truck. That truck shows you want cold, hard cash. Money I can get my hands on, liquid. Remember, before we start investing in asset allocation, we should have already prepped and have in order and operational an emergency fund. An emergency fund that will cover all my deductibles on my car, my medical and my home, anything for repairs on my car, repairs on my home. All these things should be in place, including maybe 90 days of wages in case you lost your job for a period in time. You want to have that first, and that emergency fund has to be somewhat liquid and really cash equivalents. And then the last one, of course, you want to be able to get into some bonds. Some people are just too conservative and they want to be able to get into the kind of bonds where they can actually use a more conservative approach, and they're using this conservative vehicle here. I want to have bonds. I want to be able to look at something that's like treasury. People like treasuries. They're pretty safe. It's a United States government issue. They like investment grade bonds. Bonds that have higher ratings like AAA, AA+, single A, all the way down to triple B+. They want to stay within investment grades. People who have a little bit more risk tolerance might want to go down to non-investment grades because the yield might be better. But remember, you're looking at different basic categories. These are macro categories when it comes to asset allocation. So I want to be able to look at this and say, okay, What should I do as an investor? Now, when I'm looking at this, it says here, rather than staying away from investing in the face of potential uncertainty, you can adopt a strategy called asset allocation. It isn't let me say, a silver bullet. In fact, actually, I have a comment here at the bottom of one of our books. And again, remember, you can have these books and we'll send them to you. I think they're $9.99. It says, a word of caution. Asset allocation and diversity are strategic tools that you can use to help protect your portfolio against some of the risks in investing. But there's no guarantee that a carefully allocated and broadly diversified portfolio will ensure a profit or protect against losses, especially in a falling market. It's a tool. It's not a silver bullet. It's a basic reference point. And that's all it is. But we have found it up to be there's some axioms here and science behind it that we can kind of adopt for a long haul strategy. Remember, when we're in asset allocation, if you need your money in less than 3 years, this is not the place to be. You need to be liquid equivalents. You shouldn't be thinking about the minimum time and horizon. The short horizon should be about 5 years. I like midterms, 10 to 15 years. And long term, anything over 20, especially retirement monies. If you're a millennial, you're looking a long haul. Remember, by the time you go out to retirement, we could be looking at age 70 as the new benchmark for retirement. So when I'm looking at this, I want to look at asset allocation. And sometimes, as I said before, some assets are not as, we can't totally dismiss ourselves from correlation in the market. So what we're trying to do is figure out what has the least amount of correlation. Generally speaking, a lot of people that do indexing, they buy S&P 500 as an example. They might want to be able to also punt into a bond account during times of trouble. So they're going to be trying to time the market. It's difficult to do that. And I say that if you're doing this yourself or you have a financial advisor, most advisors will not recommend market timing. So when I'm building my portfolio, I'm looking for my risk tolerance score, defining who I am, and then starting to build my thinking on the macro categories of equities, cash equivalents, and bonds. Those are the big ones. Now there's subsets to all this, and we'll get into that throughout the week. But the biggest issue is do I have correlation? How can I make my correlation the least amount of correlated to the market? If I put everything in one side of the market and the market tanks, if I put it all in equities as an example, if I put it all in equities, that's great when the market's going up. But what happens when it starts to go down? Then I start to expose myself to major losses, faster losses, it seems like, at least on the history. If I keep it in cash all the time, I'm only going to be doing cash equivalents. The best 5-year rate out there right now at the time that I'm recording is a little north of 3.4%, and that's an annuity. That's not even in a bank. So if you wanted a 5-year lock and you thought the market net of all fees was not going to exceed 3.4%, you might want to look at that, and that's an annuity, a 5-year lock. As the Treasury starts to move the numbers up in interest rates, you'll notice that annuities will start to move up. CDs will start to move up as well. But bond accounts will be exposed to rising interest rates. The value of the bond will go down. If you think that that's going to happen, and of course, unfortunately, for the last decade, almost every financial advisor thought sooner or later, we have to start raising interest rates. Well, as you know, they were slow to raise, and we're just now in the last year and a half or so, slightly raising them an eighth here, a quarter there. So when I'm looking at this, I'm trying to figure out what can I do to build a model. Now, I'm going to give you 4 things before we close out the segment. To determine asset allocation that's right for you, you'll want to consider where you are now financially, where you want to be in the future, and the money that you'll need to get there. And here are 4 basic steps. Number 1, you want to make sure you take an inventory of your current assets. So I'm going to go ahead and look at everything I have in banks, annuities, cash value life insurance, and my 401k. If I'm in a defined benefit plan, I want to see it all and get a good inventory. Make sure my spouse knows all that I have and the accounts, and make sure that both in a married couple with good trust, you'll want to make sure everybody has information and we know exactly what we're trying to get done. Number 2, you need to estimate the future contributions you're going to make on these accounts. So in my 401k, I'm always putting money in there, especially if my employer is matching my contribution. If I'm not getting matched and I'm not in a high tax bracket, I don't know if I even want to be in ERISA, where which means a 403b or an IRA or a 401k. Number 3, define your financial objectives and project what that will cost. All products have costs. Let me just underline it. All products have costs. You want to mitigate your expense loads. A lot of people like ETFs for that reason, or indexing for that reason. It seems to be a cheaper way, and the returns have been decent. So I didn't really need to have a hands-on management, whether it's my financial advisor or a money manager. So calculate the return that you must earn on your assets in order to meet your goals and objectives. You're going to have goals, you're going to have objectives, and what's the rate of return to hit those numbers? These 4 basic ideas are the beginning points, along with finding out what your risk tolerance is, to make you determined to begin to build and construct your own portfolio. Don't forget to watch our next segment on Investing with a Purpose, part 2 in our series on Understanding Asset Allocation. And keep in mind, before moving forward with any of the ideas on the show, always check with your tax consultant, legal counsel, or your financial advisor. You've been watching Steve Savant's Money. Name of the game.